On April 7th at 5:32 p.m., Donald Trump announced a ceasefire with Iran. And from this announcement, we learned two things. First, Truth Social is the single greatest invention of our generation and is totally not a useless social media platform. And second, markets don't like uncertainty because the very next day after the announcement, the markets ripped. The S&P closed up 2.5%, the Nasdaq almost 3%, and the Dow climbed more than 300 points, marking its best day in almost a year. But it didn't just stop there because a few weeks later, stocks were back at record highs. Even as the ceasefire was actively falling apart in real time, traditional financial media was calling this a relief rally, that the markets were celebrating peace. But the truth is, that's not what this was. This was something else entirely. But to understand what actually happened, why markets can be at all-time highs when there's a war going on, you first need to understand what Wall Street looked like going into this, because there's a lot more to this story than just a relief rally. On February 28th, the U.S. and Israel launched joint airstrikes on Iran. Supreme Leader Ali Khamenei was reportedly killed. Then Iran shut down the Strait of Hormuz, and the market had its worst 5-week losing streak in nearly 4 years. The S&P was down nearly 9% by the end of March. And while your retirement account was quietly screaming, there was something else happening beneath the surface. Wall Street was beginning to panic. Hedge funds didn't just start repositioning, they were selling at the fastest pace in 13 years. And that's not a loose estimate, that's hard data. Goldman Sachs had a front row seat to the action. They run what's called a prime brokerage desk, which services most of the major hedge funds on Wall Street. That means they see what these hedge funds are buying, what they're selling, and just how leveraged they are. And according to Goldman's own numbers, Q1 hedge fund selling in North America was the largest since April 2020. Gross leverage was sitting over 300%, near an all-time high, and short exposure to macro ETFs like SPY and QQQ hit the highest level since the pandemic. Then, on March 19th, commodity analyst Rory Johnston said this: "If you think about some kind of massive disruption in the oil market supply chain in the Middle East, and there's this shockwave moving outward. The shock is too large for the system to handle. It will begin to creak and break the longer this goes on." When asked how big the disruption could be, he explained that even under relatively stable conditions, with the strait still closed, the world would need to cut around 15 million barrels per day of demand. That would likely push oil prices to $250 to $300 per barrel, levels that would almost guarantee a deep global economic downturn, potentially worse than a recession. Fast forward 6 weeks later, and this might be one of the most ironic takes of the year. At that point, the sentiment on Wall Street was clear. Everyone was bearish. Then, on the evening of April 7th, Trump announced the ceasefire. And when markets opened the next morning, it was like someone flipped a switch. Over 400 names in the S&P finished green. 13 stocks hit all-time highs. Brent crude dropped around 13.5%, and WTI crude fell over 16%, marking the biggest single-day decline since April the 2020. But here's where the mainstream explanation starts to fall apart. According to maritime intelligence firm Windward, which uses AI to cross-reference GPS data with satellite imagery, only 5 outbound carriers were detected moving through the strait by midday. That's a roughly 96% drop in activity compared to the pre-war average of around 130 daily transits. So, something doesn't add up. How can there be a relief rally based on peace if there isn't actually peace? Which raises the real question: what actually moved the markets? The answer is a classic short squeeze. To understand this, you need to know how short selling works. When you short a stock, you borrow shares and sell them, hoping to buy them back later at a lower price. But If the price goes up instead, you're forced to buy those shares back at a higher price, locking in a loss. And if enough traders are forced to do that at the same time, it creates a feedback loop. Prices rise leads to short, sellers cover leads to prices rise even more. That's a short squeeze. And on April 8th, with short exposure at extreme levels, the squeeze began. But that was just the first domino. Once prices started rising, algorithms kicked in, specifically CTAs or commodity trading advisors. These are systematic funds that follow trends, not news. When markets fall, they short. When markets rise, they go long. Goldman reported that CTAs were sitting on roughly a $30 billion net short position going into the ceasefire. But once key levels were breached, those models flipped, and fast. Originally, Goldman estimated CTAs would need to buy back about $40 billion in equities. In reality, they bought $86 billion in just 5 trading sessions, one of the fastest buying surges ever recorded. Then came the third domino, the options market. Options dealers aim to stay delta neutral. That means when traders aggressively buy call options, dealers hedge by buying the underlying stocks. At the time, the market was in a negative gamma regime, where dealer hedging amplifies price movements instead of stabilizing them. So, as prices rose, dealers bought more, which pushed prices even higher. So, what you had was a chain reaction, a short squeeze to CTA, buying to options-driven hedging. 3 powerful forces, all reinforcing each other. That's what caused the rally, not peace. And the interesting part is this isn't new. We've seen this pattern before. In December 2018, markets were falling on rate hike fears. Then Jerome Powell said the Fed would be patient, and the Dow surged over 1,000 points in a single day, or in August 2024, when the Bank of Japan raised rates, triggering a sharp sell-off followed by a massive rebound. Different triggers, but the same underlying mechanics. Because the structure of the market has changed. 20 years ago, markets were driven by human decisions. Analysts studying fundamentals, investors evaluating businesses. Today, over 63% of U.S. equity funds are passive. That's more than $13 trillion that simply tracks indexes, regardless of valuation. And since most indexes are market cap weighted, the biggest companies attract the most capital automatically. That's how the Magnificent Seven now make up over 33% of the S&P 500. Meanwhile, hedge funds have consolidated into massive multi-strategy firms like Millennium, Citadel, and Point72, operating with high leverage and strict risk limits. When losses hit a threshold, they don't debate. They sell immediately. And underneath all of this is the options market, where same-day expiration contracts now dominate trading volume. On peak days, over $2 trillion in notional value changes hands. Every one of those trades forces real-time hedging, which directly moves stock prices. So, the dominant players in today's market aren't analyzing fundamentals. They're reacting to price movements. And when all those reactions stack together, you get massive moves like the one on April 8th. Once you understand this, the market starts to make a lot more sense, because what looks irrational on the surface is often just mechanics playing out underneath. And the headlines? They're just stories people tell to explain moves after the fact.